Right now, Europe's largest economy is breaking down. The country's top economic research institutes recently slashed their 2026 GDP growth forecast in half, dropping it from 1.3% to just 0.6%. A violent external shock ended a 10-month sequence of growth, derailing the recovery in a single quarter. The core manufacturing engine of the Eurozone is seizing up, and the vibrations are starting to threaten the stability of the entire currency bloc. In March 2026, diplomatic relations collapsed, and Iran's new supreme leader, Mojtaba Khamenei, ordered the Strait of Hormuz closed. The blockade immediately cut off a massive artery of global commerce. 20 million barrels of crude oil per day, along with 20% of the world's liquefied natural gas supply, became stranded on the water. Energy markets reacted instantly to the physical shortfall and the threat of further disruption. The price of Brent crude spiked past $126 a barrel, driven largely by a massive geopolitical risk premium. A regional military standoff turned into a direct, unavoidable tax on heavy manufacturing across the globe. Germany's industrial model was built on a foundation of low-cost energy imports. Today, that cost advantage has evaporated. This bar chart compares nominal electricity end-user prices for the industrial sector. Looking here at Germany, manufacturers are paying €176 per megawatt hour. In Texas, that same power costs €57. This line graph maps the trajectory of natural gas prices, and the gap is even wider. European gas is now roughly 3 times more expensive than natural gas in the United States. That stark difference in overhead breaks the core math of the Verbund model, Germany's system of highly integrated, energy-intensive chemical and manufacturing plants. Producing heavy goods domestically now guarantees a loss. The system is mathematically trapped.
You might look at some recent data and think the bleeding has stopped. April's Manufacturing Purchasing Managers Index, or PMI, sat at 51.2, which technically points to slight growth. But as this S&P Global PMI report shows, the broader composite index actually dropped to 48.3. That slight manufacturing bump is a lagging indicator. Factories are simply clearing out old order backlogs, not bringing in new business. If we look lower down at the prices charged and input crisis graphs, the data shows momentum turning negative. Both lines show sharp, sustained upward spikes in cost pressure, while service sector activity has hit a 41-month low. The statistical recovery is a byproduct of clearing old orders, masking a slide back into contraction. Look at BASF's massive chemical complex in Ludwigshafen. For over a century, this site has been a bellwether for German economic health. In their 2025 annual report, BASF revealed an operational loss of over €1 billion at the Ludwigshafen site alone. High energy prices simply erased the margins on their basic chemical products. The company has already cut 4,800 jobs and started systematically shutting down older, energy-intensive production units across the facility. BASF is decommissioning the fundamental units of its domestic value chain, dismantling a core pillar of Germany's historical industrial base. Global demand for chemicals hasn't disappeared. The production is just migrating to regions where the spreadsheet balances out. BASF is replacing its German capacity with a sprawling new megaproject in Zhenyang, China. The facility runs entirely on renewable electricity, securing a reliable cost structure that no longer exists in Ludwigshafen. If the most advanced, highly capitalized firms in Germany are abandoning the continent, the rest of the supply chain will inevitably follow. The hollowing out of German industry leaves the broader Eurozone without its central economic anchor, leaving the entire currency bloc adrift. For decades, a quiet economic arrangement powered the European Union. Germany acted as the primary factory floor, importing parts and raw materials from peripheral nations and assembling them into high-value exports. That single manufacturing base pulled the entire continent's economy forward. German production costs have reached a permanent plateau, representing a structural break in the country's industrial model. Industrial manufacturers are not trying to wait out a downturn. The capital is actively leaving Europe. Because the European supply chain is tightly interwoven, the consequences bleed across borders. When Germany's factories stop ordering parts, the surrounding nations lose their biggest customer, and the interconnected system begins to shut down. Volkswagen faces the exact same brutal operating costs and cratering demand at their domestic facilities in Germany. Compounding the domestic pressure, Volkswagen is steadily losing market share to highly competitive Chinese electric vehicle manufacturers who can build and price their cars at a fraction of the cost. Volkswagen is accelerating its pivot eastward in response. They plan to launch 30 new electrified models in China by 2027. More tellingly, they have begun using their Chinese factories as export hubs to supply the Middle East and Southeast Asia, bypassing their European plants entirely. For these industrial titans, the calculation is complete. Maintaining a heavy industrial base in Germany no longer makes mathematical sense. To halt the industrial exodus and calm the markets, Berlin announced a staggering financial intervention, a €500 billion special fund for infrastructure and climate neutrality, or the SVIK. The government promised this massive infusion of debt would modernize transport grids, digitize the economy, and retain heavy manufacturing within German borders. This is a report from the German Council of Economic Experts, the body that audits federal spending. They issue a clear, direct warning. The principle of additionality in the federal budget is being undermined. The ruling coalition needed a massive headline number to reassure terrified voters and markets. The problem is, they didn't have the actual cash to back up those promises. By law, emergency debt like the SVIK is governed by the rule of additionality. The borrowed money must be added on top of the normal budget to fund new, growth-enhancing projects rather than paying off existing obligations. This chart compares fiscal plans of the previous and current coalitions. Berlin uses the emergency fund to quietly plug budget holes. Look at the core budget allocation dropping. Standard investment spending was slashed, and special funds simply backfill those exact projects. These area charts project the long-term impact. By financing basic consumption with emergency debt, this yellow band of non-growth spending expands. Because this debt doesn't generate industrial expansion, the national debt ratio is projected to push past 85% of GDP by 2035. Berlin is leveraging the country's future credit to hide a structural collapse from the public. Because the German recovery is an accounting illusion, the shockwaves are spreading outward. International supply chains that rely on a healthy German market are beginning to fracture. Finland is highly exposed. Their entire economy relies on exporting heavy capital goods, intermediate parts, and raw materials directly into the German industrial machine. As BASF and Volkswagen relocate operations to China and the Americas, demand for Finnish exports flatlines. Without those purchase orders, Finnish corporate revenues evaporate. This graph maps European economic policy uncertainty against Finland's consumer confidence. When factory orders dry up, households become risk-averse and abruptly stop spending. Notice the exact divergence. As the teal policy uncertainty line shoots upward, the purple consumer confidence line collapses into negative territory. With collapsing export revenues and paralyzed consumers, the Finnish government is forced to borrow to maintain basic services. Their national debt is now projected to exceed 92% of GDP, triggering punitive deficit procedures from the European Union. This €500 billion fund serves as an autopsy of the German industrial model. With its primary engine relocated, the continent faces a future of structural debt and permanent stagnation.